Well, hello everyone. Thank you for coming again. And as I mentioned earlier, Peggy, John, and Cliff are away at their annual summit here in Florida. And so I'm the one running the show today. And we just want to say thank you for being our diehards and showing up every week. So let us introduce you to our guest speaker today, Desiree Doubrox. So she's as an entrepreneur. She's been an entrepreneur since she's been 12 years old. Um, she's always been the founder of her own businesses such as Mermaid, A Model Media, Looking Good Productions, and Celebrity Auctions. After leading a successful career in real estate in 1989 as a broker, investor, and creator of seminar series entitled From Babies and Bills to Riches in Real Estate, Desiree, a divorced mom of two sons, saw that very capable, intelligent women were letting other outside forces stand in their way of making and pursuing their investment choices. So in 2006, she started inviting women into her home for champagne brunches and had speakers speak on subjects such as getting out of your own way, destined for greatness, finding the diva in you. And in 2011, they launched the Foundation of Empowered Women, a nonprofit division and association of an empowered woman with chapters throughout Southern California. In 2015, Desiree produced and published Let's Talk Success, a digital magazine distributed in 11 countries with access to over 1 million viewers. It features women who have achieved millionaire status as they share their stories, challenges, victories, and secrets to success. Best described as a mother, advocate for business women, entrepreneur, speaker, author, radio and TV show host, producer, publisher, founder, and an empowered woman, dancer, hiker, traveler, and yoga enthusiast. Now that's empowering. Thank you very much for joining us today, Desiree, and you can take it away.
All right. Is it okay if I share my screen?
Sure. Let me just give you that. Let me give it to you. Here we go. You have it now.
Okay. All right. Let me now find what I was looking at, and then I will present it. So I'm currently in Cabo. This was one of our projects that we just completed. We came because they had a storm a couple weeks ago, and we had a lot of repairs that had to be done. So again, I apologize, but I am in a beautiful, wonderful place. And how we acquired this property is through syndication. How many of you have participated in, invested in, or are syndicators? Can I kind of either get something in the chat or get a raise of hands or some response to that? That way I know, am I starting from scratch or basics? Yes, no? Anyone? Okay. All right, I can't tell. So anyways, what we have is Syndication Simplified. And this is perfect for someone who is a realtor or title officer, mortgage broker, or someone that's familiar with the industry. And I'm assuming a lot of you are because you've been part of Peggy's tribe for a while. And if you enjoy supporting others and building their real estate portfolio and their wealth and their legacy, this is perfect. Or if you have the knowledge, the money, credit, the time, or the resources, then investing in syndications is really good for you. I'm going to go through two parts, one as investing in syndicators and one as being a syndicator. And that way you can kind of see which one will be most of interest to you. This is either way, whether you want to be a syndicator or invest in a syndicator, it's a very, very lucrative world for people that are involved in it, both again as an investor or as a syndicator. So I'm Desiree Doubrox, and again, she mentioned that I'm a real estate agent since 1989 and a broker. I recently, in the last 20 years, just concentrated on investments in both residential, commercial, multi-residential, triple net, fix and flips, and commercial property, as well as short-term rentals, and also a publisher and a podcaster. Whoops, I'm sorry. And then our co-founder, as well as the CFO, is Gary Zimmerman. And he's invested in over $15 million worth of investments, syndications for both commercial and industrial. But he's also a partner investor in the Cola Villa, which is Golden Hill, and the Costa Azul. He's also a mechanical engineer and design manager with Titleist. He designs golf clubs, but he brings his skills, his financial skills, to us as our CFO. So what is syndication? Okay, syndication simply involves bringing together a group of individuals between 2 and 10 people, but sometimes as many as hundreds, and they pool their money together and purchase a property. So some of you may have participated in one without even really knowing what it is. Many times it's a small group of people, they're joint ventures, and they are invested in it. You buy a property, everyone pulls in some money, and you get it, and you fix it, and you sell it. But syndication actually just involves something that's more larger amount of money usually and a larger group of people, and they are secured with, or they're involved and secured by the Securities Exchange Commission. And so that's all that syndication is. A lot of the buildings that you participate in, whether it's parking spaces or shopping centers or office buildings and medical buildings, majority of those are all syndications. Even the ones that actually that people that have money, that you'll find out, the Murdochs and people like that, they don't use their own money. They actually will get investors' money and put together to buy these buildings. So you probably are going to participate in many more than you know of. There's different types of syndications, including real estate syndications, there's venture capital syndications, and media syndications. Now, many of you have probably heard of the media syndications, like the different shows and the movies that are being syndicated. So that's pretty common. And those are pretty evolved. But then also the venture capital syndications are people pulling funds together from investors to invest in startups and businesses. And actually, Homework was started with a syndication. And I put together because it was anything that involves a lot of cash intensive, that's what you want to be able to utilize syndications for. And then again, as well as the real estate syndications, where you pull funds from multiple investors to purchase or manage a real estate property. So there's laws of real estate syndications. It's a securities law, and that's usually governed by the Security Exchange Commission. And they vary in different states. Some of them are different states that have different laws, but it's not as scary or as intimidating as people think it is. You actually get an attorney. It has to be a securities attorney that knows the laws in the different states. They draw up your documents for you, and you follow those documents. There's like you have PPM, which is a private placement memorandum. There's a subscription agreement, which basically spells out all the things that you're going to do, what you're going to do with the funds, who's involved with the funds, what your time period is, how long you're going to hold the asset. Usually there's a range between 1 to 5 years or 2 to 5 years. It spells out what you're going to give your investors, whether you're going to give them dividends monthly, quarterly, annually, or whether you're going to give them just the equity split. When you sell the property, you split it among yourselves and investors. So it spells out everything, as well as the operational agreement. How you plan to operate this. Is it going to be operated as a hotel or office building or as a storage unit? So it just kind of spells out so the investor knows all the details. And as I mentioned, it's regulated by the Securities Exchange Commission, but again, it's not intimidating. It's very easy to participate and follow through. You simply register, you fill out the papers, and you register it. And then it's investment regulations. Real estate syndications must also comply with investment regulations to ensure that their offering investments are suitable for the investors. And they vary from state to state. Each time you have a syndication and someone signs up, you register that investment with that state. Different states charge different amounts. For example, some states, in California, of course, being one of the highest is $350, but some states are as low as $30 for a registration. So you want to find out what state you're going to be participating in. Once you register with a state, with one investor, if you have other investors in that same state, you don't have to register again. You still send in their information, but you don't have to pay a registration fee. And then there's also tax laws, there's tax implications, but usually it's for the benefit of the investors. There's different types of cost segregation, different types of ways that you can now utilize tax advantages you can utilize, which is very advantageous to the investors in the syndicators for investment. but you just want to know that somebody knows that information. So there's two types of private placements under the Regulation D, which is the most common one that you'll hear about. There's a Rule 506B and Rule 506C. And 506B means that you do not have to have, you do need to have a pre-existing relationship with the investor, which means that some people say it's 3 touches, some people say it's 7 touches, some people say simply a conversation with that person that you've had with them saying, okay, what do you own now? What have you invested in now? What do you want to invest in? What cash do you have advanced? Are you using your 401ks? Do you want to be able to say that you have some knowledge of this person and how sophisticated they are in their investment experience? You cannot advertise in the open public with a 506B, and you're only able to have 35 non-accredited investors. You can have many as you want accredited investors, but only 35 non-accredited investors. 506C, however, allows for general solicitation or advertising, and that's for accredited investors only. So it means you can put it on your social media, you can put it in a newspaper, you can send out flyers and so forth, but you can promote your investment opportunity to non-accredited investors. And you're able to have as many non-accredited investors as you want. Now, what's the difference between accredited and non-accredited? Accredited investor are the ones that have a value or net worth of $1 million or more, excluding their primary residence. Or they make $200,000 in the last 2 years as a single person, or $300,000 in the last 2 years as a single person, and anticipate of doing the same. A non-accredited person does not need to comply with any of that. They can be just someone that's just starting out, that there's no qualifications at all, just somebody that you have an existing relationship with. So there's the investor, and then there's the syndicator, sponsor, or general partner. And most of the time, it's referred to again as a syndicator or a GP. And that's the individual or company that's in charge of finding, acquiring, and managing the real estate. You have a history of real estate experience and the ability to underwrite and do the due diligence of the real estate asset. So again, it could be someone that's invested in real estate, someone that's involved in the affiliated services such as title and escrow, or be a realtor itself, or just simply be a seasoned investor. So then you have the investors or the limited partners. So again, the people that run the syndications are the GPs, and usually the investors are referred to as the LPs, limited partners. And those are the individuals that invest and own a percentage of the real estate. They get the benefits of the property ownership, but they're not involved with the acquiring the property, arranging the financing, or any of the day-to-day management. And this is as passive as you can possibly get. You simply put the money in, wire it, send the check in, and you get your dividends. You have no involvement thereafter until that property exits. Until they exit the property. So again, for those who really want passive real estate, this is a perfect opportunity for you. So now, as an investor, as I mentioned, you're going to have the be accredited versus a non-accredited. Now they refer to the non-accredited as a sophisticated investor. And one of the advantages is that you can invest in anything. It could be multi-residential, commercial, industrial, storage units, hospitality, retail, student housing, retirement, and there's any other type of real estate that's there that you want to be able to invest in. So it allows you as an investor to diversify your portfolio. You're not only combined to buying 1 or 2 different asset classes, you're able to diversify it. But before, this is perfect for the people who do not want to be hands-on, who do not want any tenants, toilets, or tantrums. Does that look familiar to any landlords out there? But if you're looking for a passive income, you want to build and diversify your portfolio, because you can put a little of investment in a few different things. You can leverage your resources. It's investing made easy. When they sell the property, if you're an equity partner, you get chunk money. So you get a large percentage of whatever the equity is. You're able to pursue your own personal dreams, and it's more recession proof because all of your eggs is not in one basket. You're able to diversify your portfolio. So for example, if you had $200,000, you could have $50,000 here, $50,000 here. and here in different asset classes or different projects, and kind of just balance out your portfolio. Many times people start off that way so they can see which one they resonate with the most, whether it's the asset class itself or the way that the interest rates or the growth of it, but it gives you an opportunity to explore. You're not locked into one project. So this is perfect, again, if you want passive income with consistent dividends so that you can travel and enjoy the freedom and flexibility. And now what a lot of people don't realize is that they can use their retirement funds to invest. I've had many people say, well, I don't have any money right now, or I'm very limited in my savings right now, whatever. Many of you may have funds in a self-directed IRA or a solo 401k. Well, those funds are traditionally held by a custodian, whether it's Charles Schwab or any of the other companies. I can't think right now, Charles Schwab or any of them, any of the other companies that right now. Well, what happens is they simply will move those funds from that custodian to another custodian, which is typically called like an equity net or invest next. They're custodians that will have your funds and they will invest it not only into real estate, but they'll invest it into notes, into startup companies and Bitcoin and all kinds of other investments that you are now directing your funds to. So the difference is that most of the ones that were the Charles Schwabs or those with the custodians, they have a money manager or market manager who manages the investments, and they get paid flat, X amount of dollars, a great, very usually six plus figure for doing that. Whereas if you win, the market is good, they get paid, and they also many times get bonuses or a percentage. If the market is bad, they still get paid, and you take the loss. So the difference is, say, for example, they're giving you 2%, 3%, 4%. They're invested into an asset that's giving them 10% or more, 12%. They're keeping the spread, they're keeping the difference, and they're just giving you the amount. So the difference is you taking the direction and saying, I want my funds going over to another custodian. There's no tax, there's no fees, there's no penalties, there's nothing that related to that movement. And you go to another company and they will, again, you just direct them. You become the manager. You say, I want this money to go into this, this, or this, or this. So self-directed IRA. So a lot of people have, again, a lot of funds there, even in the military. I think it's the TSPs. They've got funds. So different industries call it different things. But if you're working with the company or you think you have something, contact your HR person or contact your money manager. And many times you'll be surprised of what you have available to invest. And obviously getting a much higher return. Most syndications are going to be 8% on up to 20, 22%. It's not uncommon. So it's a big difference in being able to get those funds, especially if you're in the stock market and it's fluctuating. Oh, I'm sorry, this keeps turning back. And market keeps stuff fluctuating, then then it can. Okay, so that's a great asset for a lot of people, or that's a great asset for a lot of people that they have and they don't realize they can use it. What you gain from investments is the property appreciation and the rental income. So the rental income is distributed to the investors by the sponsors, either on a monthly, quarterly, or annual basis. And then there's some exceptions where it's only distributed when the property is exited, either through a refinance or through a sale of the property. But many times you'll have some monthly income coming in. And if it's with a self-directed IRA or one of those funds, what happens is that the money comes and goes directed back to them into your account. That's why it's not a taxable event, because you're not withdrawing the funds. You're actually just moving them and then taking them out and contributing back to them. So this is an example. This gives you an example of kind of returns that you can get. Looks like it's cut off a little bit, but I'll be able to share it with you. This is one, say, for example, you invested. This was one that we did fixed note, which is the Class A, and then the other one was the equity share. So some people want to know exactly what they're going to get. So the Class A, if you invested $50,000, in year 4, you would have gotten a 7% return. So you would have gotten 14%, $14,000. And then they have a $14,000 catch up, which means that every month you're getting 7% on your investment. But then at the end of the event, when it's again at the exit, you get 7% per year catch up. So it means like your total is 14% return on your investment. So you invest 50, you get 28,000 and then walk away with 78,000 in year 4, or year 5, 85,000, and year 6, 92,000. And that's again a straight interest rate. And that happens again, what I'm using is the 14% total. And the class B is a combination. You get 6% on your investment paid monthly, but then at the exit, you get a percentage of the profits. In this instance, they were splitting 50-50. So after, when the property is sold, after the costs are deducted, you split with the investors 50% of the profits. So you get 6% along the way. But they estimated they utilized a 10% cap rate on this property. And that's how they got the $28,000 return. So let's say it's a total of 40. So you invest 50, you walk away with 90 in year 4, 96 in year 5, and over double your money in year 6. So again, it's a completely much more profitable. I think it calculated to approximately 21% at the end of the day. So you get much more on the investment. But again, this one is that it's flexible because you don't know exactly the exact amount you're selling the property for, but you do know what you get on your return. But whenever that profit is, you get 50% of it. So there'll be different types of transactions that you'll see. You'll see, again, some that are strictly a note and some are equity. And this would be like the same type of model if it's $100,000, and this was a 8% fixed. So it was 16% total. So on $100,000, you get 164, 180, 196. And then on the flex class B, 183, 198, and 202. So you can see that in a short period of time, and the average syndication, you can double your money, which is much more, much more aggressive in the market. So that's as an investor. Now let's switch hats and put our syndicator hat on. What does it look like as a syndicator? Well, it's a big task. It's much more approachable by distilling it down to 3 fundamental phases. And that's going to be the acquisition, the operation, and the liquidation. So the acquisition. So what's involved in that? Again, this looks like a very lengthy list, but it's the same type of list that you would have if you were buying something on your own individually, really. And it's just some of the things are applicable, some things are not. So you find real estate agents, you research the properties, you underwrite the properties, which means that you just do the numbers, see if it works. If it doesn't work, if it works, then you find legal. Legal is very easy. It's very affordable. It's approximately $15,000 to $20,000. That's what our attorneys cost. It's worth it because you're raising millions of dollars for the most part. So they have their, protection. You get investors. Investors are usually people that like and trust, especially if you're a real estate agent. You've got a list of people who have been working with you, or if you have family or friends, or you belong to a group or organization, whether it's even if it's the PTA or surfing group. I mean, there's a lot of people. Once you start putting together your warm list, that you realize that would be potential investors, especially if they're using this self-directed IRAs, because that includes like all the teachers and the firemen and the policemen and government workers and, just office workers, people that have money invested in their accounts. Then you do the accounting. You find an accountant that's familiar with whatever your asset class is to do the accounting. You go into escrow. Then you hire a team. Get your inspections, like your normal home inspections, roof inspections, full inspections, whatever is involved. Utilities, get the utilities turned on. If there's renovations to be involved, then you handle the renovations. Interior design, if there's any interior design that's involved, you do that. Your PR, you promote your property, and then you're ready for your launch. Then the operations. The operations, during the time you hold the property, you get an asset manager if it's more than 2 or 3 properties. Otherwise, you can manage it yourself. You have someone handling their relations with your investors, which means that you communicate with them on a quarterly basis or annual basis, whatever's appropriate. You advertise or promote the property or the company. You have your admin, whether it's your assistant or your secretary or accountant. You have your accountings. You have your legal. You have property managers to manage your properties, and that may involve having housekeepers, handymen, gardeners, pool service, fumigation, or maintenance. But some, again, that's for mostly hospitality. If you have a storage unit, you won't have all of that. So it just depends on the asset class you invest in or that you're syndicating. You would have the operations accordingly. But it's no more than you would in a normal rental that you would have. And then the liquidation. The liquidation, you have to prep the property for liquidating, which means prep it for showing or for photographs or whatever way you're going to sell it. Maybe some construction if you need to paint it or refurbish it a bit. Real estate agents, the appraisals, inspections, disposition of furnishings if it was something that was furnished, moving, legal, or accounting. So again, it's a lot of it's a normal task you would have in any real estate acquisition or disposition of it. Now, you may be wondering how you make money. So I'm going to ask you to hold that thought for one quick second because I'm running out of power. I'll be right back. I'm going to make sure I plug in.
While Desiree's gone, I don't remember if we saw a raise of hands of who might have already been involved in syndications. Anybody here? No? Oh, okay. All right, Francis, thank you. I'm just curious.
I represented a syndicator, if that counts.
Oh, yeah? Okay, good. Oh, that's great. And where again, Jack, are you? California?
Yeah, I'm in the Valley, San Fernando Valley.
Okay. Okay, cool. That's good to know. Of course, I'm thinking that if you are in California, you can only work on syndications in California, correct?
No, not necessarily.
Correct.
Okay.
Nope.
Not necessarily. You mean like the syndications? And because like we have a syndication, my associate is coming down with my charger, so he'll be bouncing in 1 minute. Well, we have a syndication in Cabo in Mexico, and we've had syndications in different states.
She was talking specifically about me as a lawyer.
I see. I see. Well, that's interesting because our attorneys are in Texas, crowdfunding attorneys and in Florida. So I guess it probably varies.
Okay.
It varies in your capacity. Awesome.
Well,
Okay.
we have what time is it? It is 5:40, so we're gonna need to leave some time for questions.
Okay. All right. So this is a good part. So I'll make sure that we get this part going, nothing else. Because this is how a syndicator makes money. And this is just around numbers. So it definitely is not specific. But let's say, for example, you had a $2 million purchase and you were going to exit in 4 years at $4 million. And if you're a realtor, you'd make the 3%, 120, commission. And if you happen to do construction involved, then you get a 3% construction management fee on the budget for the construction. So you get a 2%. The fees for a syndicator vary anywhere from 1% to 5% is most common. So we took the low, we took a 2% commission, just thinking you're starting and just being very conservative. So just with the acquisition fees for you doing the due diligence, finding the properties and getting into escrow, that's 2%. If you decide to be the loan guarantor, guarantee the loan, then that's another 2%. Now that can be you or it could be somebody else. Now that is a loan amount. Asset management fees. So to manage the asset, say for example, we just took $2,000 a month, a very low amount. This is $24,000, time a year times 4 years. Most asset management fees are either a percentage of the revenue that comes in, or it's like $5,000, but again, we're giving the basic. Then operational income. Sometimes you'll get a percentage of the operation income that's from the operation, but also I just put a $2,000 flat fee times 4 years here. Then a refinance fee. If you happen to refinance the property during the period of the hold, then you get a free 9 cents fee. The technology fee, that's kind of a catch-all fee for your services, for your investor portals, and for your CRMs and things of that type. Then you have an admin fee, so you're going to have an assistant or somebody to assist you, and that's only allotted $28,000 for 4 years. Very, very low. And then a disposition fee. When you sell the property, when you dispose of the property, you get a percentage of that. And so if you're disposing, if we're selling it at $4 million, 2% of that is $80,000. And then say you got a equity split, and say your equity split was only 10%, and so you have 100% of total, but let's say you just took 10%, then that 10% is $400,000. So your total that you would make by being a syndicator on this is $831,000, over $831,000 for 4 years, just managing the syndication. So that's a huge incentive for those who say, I not only, you need my email, I not only want to do this, but it gives you financing, but it also gives you a percentage of an asset that you didn't have before. Because suppose you refinance it and pay the investors off, now it could be your asset, and you put no credit and you put no money into the deal. So for a lot of people, it's a great way for them to build their portfolio and to be able to do it. I created a syndication because at the time I'm going to move a little faster, but for my business homework, I raised $250,000 for that, and it was not attached to any, wasn't attached to any asset. It was just basically built on the fact that this is a business that was being started, and they didn't get any dividends. They simply get X amount of percent on their money when I exit, when I sell the company. So that can happen anywhere, and that's co-working and co-living, which I can share with you at another time. And this is one of the properties that we did. And
Pretty cool. Okay, so we only have a few more minutes, 15 minutes for questions.
I'm going to stop that and go to the next. Okay.
So, is she finished? I guess so. I guess I don't see her. Aha. There we go. So anybody have any questions? This was a great presentation. Thank you so much. Now that I know what both sides look like, I always thought it was really scary, the syndication part.
Well, the thing is that, a lot of people think it's harder than it is to be a syndicator, and it's not. And I think you have to have a lot of qualifications and a lot of experience. If you don't have it, then you partner with somebody who does. I'm not really good at numbers, and so my husband is the CFO, so I partner with somebody who does. And we have other people that are good contractors, good at renovation and things of that type. So you just simply, explore the different options that you have.
Cool. Anybody have any questions for Desiree?
This is a client. Maybe everybody knows everything about it.
Yeah.
Has anyone, there's no one that has actually syndicated anything as yet?
Yeah, Francis has.
Francis has. Can you share with more information about it, Francis?
Sure. It's in the Dallas area. It closed on July 31st. It was supposed to close in May. And information is a little bit hard to get about it. So I'm learning the things that I don't like about it. What the information that I do get, I like because they say it's going well. I need to take a ride down there and check it out. And I was actually thinking about that this morning because I wonder if that would make them uncomfortable that I'm just there. But anyway, I'm going to do it.
Is it
But
an apartment
anyhow,
building? What type of property
yeah,
is it? Mm-hmm.
it's multifamily.
Mm-hmm.
So it's 63 units over in a Hispanic neighborhood that's very nice Hispanic neighborhood, friendly to families, close to an elementary school, very nice. And I'm pursuing an opportunity for a GP, and right now nothing is really penciling out too well. But I'm also going to be a capital raiser. And so if I can't get in with my own asset, maybe raising capital will get me to that GP position. I was interested in the fees. I've really never seen the structure of fees, and I thought that was very interesting. So, but how does that split out to all the GPs? Could you go back to that slide?
I'm sorry. Can you repeat that again? A truck just went by. How does that?
Yeah, could you go back to the slide that shows how much money you can make as a
Sure.
GP, as an
Sure.
operator? And
Sure.
I'm just wondering how that would split up for all the GPs that are participating.
So are you an investor in this project, the one you're referring to?
Yeah, I'm an investor, but I'm looking to be a GP.
Okay.
So when I've really never looked at anything that's telling me the money that you'd make. So I'm just interested
Perfect.
to hear more about it.
Can you put on present? Can you see my share? Can you see my screen?
Not yet. That's loading. Yes.
Okay, so that's how it's done. Say, for example, this is an example of a $2 million property. So the GPs, you have a choice of whether you're going to charge 1, 2, 3, again, up to 5% is normal on the acquisition. So you find the properties.
Yeah, so I understand all of that, but if you have more than one GP, how do you split all that up?
You split the equity. So usually most of the equity is split between either 50-50 with the investors, the LPs and GPs, or 60-40 or 30-70, whatever you arrange. And then the GPs split their part. So for example, I just took 10% of the $4 million, and that was $400,000. So if it was 3 of us or 4 of us, we would split that amount. So you split
Oh,
whatever
okay.
the amount that the GP takes. And then if there's an acquisition and the GPs are responsible for the acquisition or the loan, then you would split that accordingly. Like maybe usually one GP will do the loan, one GP will do the acquisition, and so maybe somebody else will do the maintenance, the management of it. And then somebody
Mhm.
else will do a disposition, especially if they're a realtor, then
Mhm.
they can do that. But you split it among whatever the amount for the general partners, you split it accordingly.
Okay.
And then
So,
sometimes you
so
get as little as 1%. I mean, some people do it just because they want to be involved, and 1% of something is better than 100% of nothing.
sure.
True, true.
Especially if
Okay.
you're a capital raiser, because that's what we do with our capital raisers. They don't usually get involved in any other part, but decides to help raise the capital. So we give them percentage, and we give them percentage that escalates per year as well, because it kind of just shows how long they've been with us and how active they are with us.
So if somebody raises funds for you, what's the going rate for that?
It varies. Again, depends on how they structure it. Some people pay a flat fee. Okay,
Mhm.
you want to raise $1 million, you're going to give me $20,000 or whatever that magic number could be. Some of them will say, give me amount of money, then maybe give me some of your acquisition fee, a percentage of your fees. Some will say, just give me a flat fee and a small percentage of equity at the end, because they will wait for that equity. And then some don't need
Oh,
the cash.
okay.
Some don't need the cash right now. They just say, give me an equity. Give me equity. Ours vary because it just depends on whether you are licensed or not as a capital raiser, or whether you are someone that is going to become part of our team as a GP. Because technically, legally, you're not allowed to raise capital unless you are part of the company or a
Right.
licensed business broker. So the most average business broker will start at 5%. I've had most of them at 5%, but I had some as much as 20%. But that 20%, those take that much, they usually can raise it really fast. They've got investors like right there. And if you've
Mhm.
got like a short 30-day window of time to raise a couple $1 million, they can do it because they have that kind of pulse in the market. But if it's someone that's having to go through, the email list and nurture it and work it, you may pay them a little less.
Okay. So thank you. I know a lot more now.
Well,
Thank you.
good luck. Good luck. And if you need
Yeah.
any assistance with doing your own, please feel free to contact us. I would love to support you, and doing
Oh,
that
great.
and support you and find out, be available as a valuable resource to you.
Thank you very much.
Does anyone else have?
Desiree,
Yes,
you may want to put your information in the chat.
I will do that. I will do that. And I think I have a QR code right here.
Anybody else have any questions for Desiree?
I'm more than welcome again to communicate with any of you. We actually have a class called Syndication Simplified. We just did one last weekend. And and it's looking back and forth here. And it's a great way to learn more. I'm gonna get to the chat, getting into the chat.
I'm curious, what's the advantage of going from a 506B to a 506C?
The
Why
advantage
would you?
506B is that you can get, we do 506B because we really want to give people an opportunity to get in and start syndicating. And a lot of them don't have $1 million assets to be able to work with. So our focus is in supporting people, family, friends, and other investors that really want to get started, because otherwise they can't if they don't have that. We do the accredited when we have a large project, like a $5 million project, and we have a short time period to raise it. So we don't have time to do 50, 50, 50, 50, 50. We have to do, and if you have a $5 million project, you're trying to get, so many people, 50 people at $100,000. So, but most of ours happen to be that because of a lot of our investors have gone with us from one investment to the other. And of course, I'm trying to do this. And I'm also gonna just say, I'm using my assistant just gave me his, popped in with his computer, and so now I'm trying to work his chat. But anyway, so that's the advantage of it. If you have high net worth people that's in your database, or people that have $100,000 or that have that, meet that criterion, then yes. Or if you want to go out there and advertise and promote for it, you can. But
Okay.
we minimize, there we go. We minimize our amount of investors. We're kind of less is more.
Mhm.
So it just works best for us.
What would you say the average investors, the number of investors you would want ideally on a deal, or it just depends on the deal?
It depends on the deal, but usually we try to stay with 20, 25, and your maximum is 35 as a B. And then
Mhm.
as a C, you can have as many as you want, but just for the accounting, I mean, some people, if this is that many people that you have to, that we are very close to our investors. So we refer to them as our partners.
Mhm.
These are people that you're a partner with us. So we are in communication. We give different events. We're talking, like our property here in Cabo, our partners can come. They get certain nice complimentary, and some of them are coming like for Christmas. She's bringing her whole family down for Christmas. So we kind of look at it as a family. So they go from one investment to another with us, which is great because I mean, each other. It's a relationship, as opposed to just a lot of strangers. But you can do as many as you want. Some people have a great bandwidth for more.
Okay, cool. Thank you.
So another question. So you could open it up as a 506B, and then at a certain point you turn it into a C?
You can do that. It's additional attorney fees. Usually they want you to designate either one or the other, but sometimes they say, okay, many times it's the reverse. Like you say, okay, I want to do the 506C. I want $100,000 minimum investment, and I want accredited investors. But suppose you don't reach your deadline. Now you have a certain
Mhm.
amount of time to raise the funds, and suppose you don't reach that, then you go to the attorney and say you pay them another 15,000 or whatever that magic number is, and say now do a 506B. Obviously it's going to take longer, but then you open it up and then you fill the rest of your investment with those people, the smaller amounts of numbers. So if you feel like if you've got 506B and you have investors and you're just not able to reach your goal,
Mhm.
you can open it up to another level.
Got
And
it.
usually you have to designate the amount of time that you're going to do this. Usually it's 1 year is most common, but you don't want that because you have to close escrow. Many times you
Right.
have earnest money there and your seller is only going to give you, 60, 90 days. But we're very transparent with our agents and our sellers. This is what we're doing. This is because, first of all, we put very little earnest money down to start with while we do our due diligence, because that's usually your money up front, only because unless you get a primary investor that's going to come in and fund from the very beginning. And so you got to do your inspection. So you don't want to do all the paperwork until all your inspections are complete and that you have a done deal. And you can always get your money back when you raise your funds, and you simply reimburse yourself, or you can lend that money to the syndication for 8 to 10%. So
Mhm.
we usually wind up investing because usually they're great deals and we don't see anything else better. So we do, but you don't have to. And that's my real point. I don't know if it's really sinking in, is that here's an opportunity for you to get assets, $1 million assets under your belt without any of your money down and without any of your credit. Because some properties we raise all cash. So it doesn't require any loan guarantor at all. So how many opportunities do you have to do that, to be able to do it? You can go in and you can keep it for 2, 3, 4 years, refinance it, pay the investors out, and now you have an asset. That's what my plan is for my retirement. Is have these multi-million dollar assets that are going to continue generating income because I've already worked them, I've curated them, I've developed them, I've got management in place, so I know what they're going to produce. And that is setting yourself up even if you have the money, why not utilize this opportunity, not only for yourself, but for other people? But I think I got off track. But anyway, so this is, that's what you can do with it. So many people say it's either too good to be true, or they don't know why they're not doing it, because why would someone not do it if you're in the real estate field and you have a desire to own property?
Right.
You know, it's the best legal way. It's not that difficult. Again, people come to a class, they learn it in the weekend. We support them in doing it. We partner with us in their deals. They can get into our deals with exceptions, which means that whatever money they have to get in, just can get in, just so they can say they've been in a syndication. And you know, it's a great. It's obviously lots less, lot less whatever it is, than, you know, selling property, you know, going out there and selling the property and listing property and trying to that's why a lot of realtors now are, you know, working with it, because they're pivoting, because they realize they can't depend on commissions anymore. And they don't want to do that for the rest of their life. So this is a great exit plan. If you don't have your retirement totally set, this is a great opportunity to say, okay, I'm going to start doing it in a year to 3 years, whatever your time period is, you'll be able to have these assets bringing you income. And it's not difficult to do. And it's not difficult. Again, if you're buying real estate on your own, you're going through escrow, you're going through title, you're going through management, you're going through property managers, you're doing the same thing. So you're just getting paid a little better for this. And I showed you at the very low, or I told you at 2%. The average is 3 to 5%. And I gave you a 10% equity, and we take 40 to 60%. So the investors get 40%, we get 60, or sometimes we're 50-50, depends on the deal. Like Cabo, we did 50-50 because it was international. So it was maybe a little harder sell for people to invest in. So we wanted to make sure we were splitting 50-50. We gave them great terms. They got up to 21%. And so people, you know, timing was perfect. People are discouraged with the stock market. Like, where can they get those kind of returns? And you're an investor, you're secured by real estate. So it's not, you know, the real estate is here. It's not going to go poof.
Okay, well, we're at the top of the hour. We'd like to respect you guys the time. And we just want to say thank you again for being here. And I'm going to stop the recording.
All right. So here's my phone number. Here's my email address. Feel free to contact me.
Oh, let me just get
All
that.
right, if anybody has any more questions. Oh, hang on. I've
Nope.
got to get back to the host. Reclaim. Okay. Well, there we go.
Interesting.